Welcome to this explainer. Today, we're jumping right into the timeless financial wisdom of Benjamin Graham. Specifically, we're looking at his legendary book, The Intelligent Investor, to uncover the absolute critical difference between building wealth over time and just, well, gambling it away. It's a distinction Wall Street loves to blur, but understanding it, that is the absolute key to your financial future. So let's kick things off with a pretty fascinating question. How do you think a certified genius, like, say, the great physicist Sir Isaac Newton, handled the stock market? You'd think the guy who literally figured out the laws of gravity and motion could easily crack the mathematical code of the financial markets, right? Well, not exactly. Back in the spring of 1720, Newton actually owned shares in the hottest stock in England, the South Sea Company. At first, he sensed the market was getting a little too crazy, so he sold his shares and pocketed a really nice profit. Good move. But then, swept up in the wild, irrational hype of everyone around him, he jumped right back in at a much higher price. And the result? He lost £20,000. To put that in perspective, that's over $3 million today. Newton famously muttered that he could calculate the motions of the heavenly bodies, but not the madness of the people. It just goes to show you, high intelligence absolutely does not prevent disastrous speculation. And that massive loss by a true genius perfectly illustrates why we need a much better approach and exactly why we're digging into Benjamin Graham's masterpiece today. Like Graham's most famous student, Warren Buffett, once pointed out, you don't actually need a sky-high IQ, unusual business insights, or inside information to succeed. What you need is a sound intellectual framework for making decisions and the discipline to keep your emotions from destroying that framework. Graham's book provides exactly that guide to survive the madness of crowds.
Section 1, The Speculation Trap. Let's look at the difference between investing and gambling.
So why do people consistently lose money in the markets? Honestly, it's mostly because they confuse speculation with true investing. We have to ask ourselves this vital question right now, every single time we put our hard-earned money to work. Wall Street is constantly hyping up the thrill of rapid trading, the idea that you can jump in and out of hot stocks and make a quick fortune. They push that way harder than the quiet, methodical discipline of actual investing. But Graham warns us that confusing these two is a fast track to financial ruin.
So what exactly is the difference? Well, let's look at Graham's exact definition of an investment. He says an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Anything that doesn't meet those exact requirements is just speculation. Notice the three big pillars here. First, you absolutely must thoroughly analyze the underlying business. Second, you have to deliberately protect yourself against serious losses. And third, you're looking for an adequate return, not some extraordinary, magical lottery ticket.
It's a really stark contrast when you think about it. An investor figures out what a stock is worth based on the tangible value of the actual underlying business. A speculator, on the other hand, they're basically just gambling that a stock's price is going to go up simply because someone else will be willing to pay more for it tomorrow. Investors judge market price by established value. Speculators base their idea of value purely on whatever the market price is right now. If the little blip on the screen goes up, they think it's a great company. If it goes down, they panic.
To really grasp why temporary success in speculation means absolutely nothing, just think about driving a car. If you're cruising on the highway at 65 miles per hour, it's safe, it's methodical, and it's reliable. You are going to reach your destination. But what if you're flying at 130 miles per hour? Sure, it's super exciting, and hey, it might even get you there faster once. You might even brag to your friends about how your strategy worked. But eventually, driving like that is going to get you killed. Flashy gimmicks in the stock market are exactly the same. Over time, they just destroy wealth. Moving on to Section 2, Fads, Formulas, and Fiascos. Let's dive into some historic market fiascos.
History shows us that everyday investors repeatedly fall for the excitement of manic bubbles. People are just desperately looking for a magic shortcut. Take the January effect, for example. The idea was that buying small stocks in December supposedly guaranteed a quick profit in January. But as soon as people figured it out, the high cost of trading those stocks ate up all the profits. Or take James O'Shaughnessy's What Works on Wall Street formula, which promised massive returns but totally fizzled out right after his book was published. Then there was the Foolish Four strategy, literally telling people to blindly buy a few high-yield Dow stocks without even analyzing the businesses. What do all these have in common? They were all hyped up as low-risk, surefire wins, and they all eventually failed spectacularly.
Graham actually warned us about this perfectly. He wrote, "All mechanical formulas for earning higher stock performance are a kind of self-destructive process, akin to the law of diminishing returns." It makes total sense, right? Once a hot strategy goes public and everyone starts doing it, the market adapts. The easy profits dry up, the formula self-destructs, and the people left holding the bag are the ones who thought they'd found a permanent, risk-free shortcut.
A textbook example of ignoring business value is the Juno Online Services disaster back in the late 90s. Listen to this. In 1999, Juno announced a so-called trailblazing business plan. They were going to give all their retail services away for free and intentionally lose millions of dollars. Sounds crazy, right? Well, the market was so completely detached from reality that Juno's stock quadrupled in just 2 days. People were buying simply because the stock price was going up, but reality always sets in. Just a year later, the stock had completely tanked to barely $1.
All right, Section 3, Timeless Rules of Investing. Let's break down the fundamentals.
So how do we actually avoid these fiascos and build lasting wealth without chasing moving blips on a screen? Graham gives us 3 absolute non-negotiable steps to true investing. Number 1, thoroughly analyze the underlying business. Remember, a stock isn't just a ticker symbol. It's a slice of ownership in a real physical company making real things. Number 2, insist on a margin of safety. This means you never, ever overpay for an asset, no matter how hyped up it is. By demanding a bargain price, you drastically lower your chances of making a fatal error. And number 3, keep your emotions entirely under control. You literally cannot let the market's crazy pendulum of highs and lows dictate what you do.
Graham sums this up brilliantly. He says, the investor's chief problem, and even his worst enemy, is likely to be himself. This is really the core takeaway from this whole explainer. Think about it, since we can never accurately predict what the broader market is going to do next, we have to predict and control our own behavior instead. True intelligence in investing has absolutely nothing to do with your SAT score. It's all about having rock-solid emotional discipline.
I really hope this explainer has shown you why having emotional discipline absolutely crushes having a high IQ when it comes to your finances. The market is always going to swing wildly between totally irrational excitement and completely unjustifiable panic. So the ultimate question I want to leave you with is this. Are you going to choose to truly invest your money using a sound analytical framework? Or are you going to let the market just gamble your wealth away on the next flashy trend? Let's stop chasing formulas and start building a real foundation. Thank you so much for joining me for this explainer, and keep thinking critically.